can see the sun, I'm rising up, I feel the love now, oh, it's in my vision. You know I ran around, and I got lost, but now I found you, well, I can't shake this feeling. Oh, it's gonna take me a little while, just to get my head around this moment. But I can see the sun, I'm rising up, I feel the love now, oh, it's in my vision. And it's telling me run, 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 don't give up. And it's telling me run, 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 and don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily NASDAQ analysis. Thank you for joining us today. There's a lot of really good information. Wow, the week is over. I hope that you had a really good week. The stock market's up. What else could be better? Well, no virus. That would be great too. But we saw that the NASDAQ was up over 2 points. The other indices were up over a point. So it was not bad. But, you know, what we're seeing right now is a back and forth with the economy. And we're seeing the market go forward. We're seeing it go back. And I know, though, a while back, there was some talk about the shape that the recovery would take. If you were looking at a graph, the shape that the economy was going to recover in. And there were those people out there that were saying that it was going to be like a V. It's going to be very quick. And there were those people that were saying that it was going to be a U. It was going to be a very slow comeback from that standpoint. And then there were those people like me that basically said it's going to be like a W. We're going to have sometimes when we're going to go forward, we're going to have sometimes we're going to go back. And if you don't believe me, I invite you to go over to my YouTube channel and look at the video that I made that is called How to Invest During a Recession. I made that about 2 months ago, and that's exactly what I said. I like to toot my own horn, especially when I'm right. Okay, we want to get into the stocks we're going to talk to you about today. And the idea in this show is that what we're trying to do is to give you some information with the stocks so that you can pick assets that will work well over the long term in a retirement portfolio or a long-term savings portfolio. We're not here to day trade. We're not here to swing trade. That's something completely different. The idea here is to give you solid information on the stocks that we're talking about. And what we do is we look at really 3 things. And if these 3 criteria can be met on any of the stocks, then you've got good stocks that could fit into your portfolio. The first thing that we're going to look at is we're going to look at earnings. Then we're going to look at the competitiveness of the companies. Then we're going to look at the stability of the companies. So without talking further about it, let me go ahead and get into what we're talking about today. The 2 companies that we're discussing are O'Reilly Automotive and NXP Semiconductors. Now, you might not think that these 2 companies are related because one has to do with automotive, auto parts, and the other has to do with semiconductor electronics. But one of the biggest parts of NXP's business is automotive. So you're going to see how that plays a big part and how that may play a big part in the growth of that company for years to come. It may also be a hiding nemesis for O'Reilly Automotive because O'Reilly Automotive could possibly be damaged by self-driving cars because we don't know what the market's going to be like for that yet. So let's get right into it and talk about these 2 particular stocks. These are great stocks. These are stocks that are in the NASDAQ 100. And this is just a little bit of information that I've put together for you on O'Reilly Automotive. It was up just a little bit today, but it's been up really very well. It's actually about a 9% rate of return on average for the past decade. We'll talk about that more in a minute. Watch this. O'Reilly Automotive, that's a great company in itself. Let's look at what they did over the past year. They started off a year ago at $395.18 and they ended today at $444.68. Now you might think that that's an expensive stock because it's a triple digit stock. It's $444.68 per share. Not as expensive as something like Berkshire Hathaway or Tesla, but it's an expensive stock, or even Amazon. But it's an expensive stock. It's right up there on the averages of what Apple was before they split. But the idea with this is, remember that those things don't really make a difference anymore. Where the price of the stock used to influence people buying it, if you find the right custodian, like the one that I use, that's called Folio. If you use a custodian that allows you to buy fractional shares, it doesn't matter, make a difference. You can buy a half share, quarter share, 0.38% of one share. It all depends on what you want to do. So over the past year, it performed at 12.47%. And look, a lot of you may be going, wow, yesterday you talked about companies that were making 60, 70, 80% in a year. Yes, that's true. But I'm going to tell you, a 9% average over the past decade is awesome. Don't get too spoiled by the rates of return on some of these tech stocks that you're seeing. The other thing that we look at is we look at the earnings of the companies. That's really important. And remember, focus down at the bottom of the graph. You'll see that the solid line in the graph is going to represent the actual earnings. That's actually what was paid. And the dotted graph is going to represent the estimated. And really, if we go back to 2014, O'Reilly has been pretty consistent. It hasn't wavered very far off from what their actual projected earnings were going to be. The pandemic has actually been working to the favor of O'Reilly for a couple of reasons. One is new cars aren't being purchased as much, and people are wanting to keep their own cars. And you notice that there were 44% of the sales from the company that were, actually it was 56%. 44% is professional, 56% is the DIY, do-it-yourselfers. So you can see that it has had a big effect. The pandemic has actually made their earnings increase significantly from that standpoint. Now, if we go a little bit further, there's no dividend in this stock. If you like dividends, hold on. I know some of you do. The next stock we'll talk about will have dividends. But one of the reasons why O'Reilly has had a boost in this particular year, especially in the second quarter, is they had great earnings. And those earnings were based on the fact that new car sales were down. People were not buying new cars. They weren't going out and test driving. The car manufacturers have really been just begging people to come in and try their cars. The CARES Act helped too, because it gave an influx of extra cash for people to fix up their older car and to keep it moving from that standpoint. Now, how a company competes with other companies that do similar business is really important. That's why every day we throw up what I call the spaghetti graph. The spaghetti graph shows you what happened over the past year. This particular one does. If you follow the dancing cursor, yes, you know this big dip right here was right at the beginning of the coronavirus pandemic. But then O'Reilly is in blue. Advanced Auto Parts, you'll see, is in red. They haven't actually, Advanced Auto Parts has been a laggard from that standpoint. And then there's AutoZone and Genuine Parts. Now, for those of you out there who think, I want to buy stocks that just have dividends, you could probably buy Genuine Parts because Genuine Parts has about a 3% dividend. But look at the actual performance. Here, let's take a look at this over the past 10 years. Remember, the past performance, no guarantee the future results. But if we look at it over the past 10 years, It's astonishing. It's had a 9% average over the past 10 years. And when you compare it to those other companies out there, Advanced Auto Parts, AutoZone's, Genuine Parts, yes, Genuine has actually paid that dividend. But which would you have rather had, the 3% dividend or the growth that you've seen in O'Reilly Automotive? I think it would have been O'Reilly. And yes, please remember that that past doesn't mean that the future is going to be guaranteed. Now, when we talk about stocks and their growth, we want to talk about the sustainability of that particular growth in itself. And we have to look at actually what the company does and some of the internal workings of that. And we quantify that with a term called a moat. This is exactly, well, precisely what a moat is. Remember that the moat is that imaginary barrier that's in between the company and their competition. What sets them apart? And with O'Reilly Automotive, they do have cost advantages because of their distribution infrastructure. They also have brand recognition, not just for their own brand products that are sold in their stores, but O'Reilly is a very popular car part company, a car parts store. If you're a do-it-yourselfer and you're accustomed to going to a particular store, that's your store. You go to that one. And there's the network effect. There's so many different people that use one particular store, and it just means that it kind of multiplies past that point. In fact, you usually hear the network effect talked about with online services, but I think brick and mortar companies like O'Reilly have a big advantage from the standpoint of what their reputation is going to be. Now, I want to talk to you just for a real brief moment about the automotive parts industry, because this is one of those things that the big companies like Google and Amazon just has not penetrated. It's still an investment area that's unique to itself. That's why you have the AutoZones and the O'Reillys and the other different car part companies. Yes, there are some online companies, but a lot of times when people are doing it yourself, they're going down to the auto parts store and they're talking to the guy behind the counter because he knows what kind of part that you need. Hey, I am guilty of using that particular type of service, and I'm glad that they're around from that standpoint. Okay, one thing to think about, though, is that yes, the past decade's been good in growth, but what about the next decade? How will electronic cars influence people repairing their own cars? How will electronic car parts influence how O'Reilly stocks and sells different car parts that have basically been for internal combustion engines? Just in my own estimation of what I've seen over the years, it's still going to continue because nothing lasts forever. They'll just retool, and they may have different parts that are there. There may be less people that are actually doing repairs on their own electronic car, since there's not much to repair there. But there's different things that need to be done. So O'Reilly and other automotive companies will fit that void, and they will also begin, I believe, to supply different electronic parts to the professional shops, because the professional shops are going to be retooling as well over the next decade. It'll be interesting to see by 2035 what's happening in California, because if you noticed earlier in the news this week, California passed I don't know whether it was a bill or a declaration or whatever the case is going to be, but they said by 2035 that there would be no internal combustion engines in California. Okay, we'll see how that goes. Okay, what has Morningstar said about O'Reilly Automotive? We saw today that it closed at $444.68. The fair market value that is being put on this by Morningstar is $378. Now, if you've ever followed me before, let me explain to you this again, and be patient with me just for a minute. The fair market value that is pegged by Morningstar is arrived at by a multiple of the earnings per share. It's not just a number that they generally pull out of the hat. They do use some of their expertise to give that fair market value a little tweaking, but they really rely upon the actual earnings of the company or the sales of the company. There are some fair market values that are calculated in a different way. But with that said, it's actually trading at a premium, and you can see that the fair market values under the current value, it gives it a 2-star rating. Remember, the star rating is a valuation rating. It's not a, hey, a good restaurant 4-star rating from that standpoint. Now, let's see what the other analysts out there have been saying about O'Reilly Automotive. Out of 18 analysts that were polled, 10 of them said, hey, this is a strong buy. Only 6 said to hold, and 2 of them said that it was a moderate buy. So this is actually what the average of the calculation comes out to. Most analysts, the average is coming out to say that it's a strong buy. Remember, though, this is not my recommendation. I'm just reporting to you what's going on in the analyst minds, what they're saying. Okay, the next company that we're going to talk about is going to be NXP Semiconductors. Now, this is a Dutch company. You might not have heard of it, but it's integral in the automotive business in new cars. This is what they do. Take a moment and watch. NXP Semiconductors, a Dutch company, has a huge influence on car manufacturing. It will also have a huge influence on cars going into the future, electronic cars, especially self-driving cars. If you saw the last part of that clip where it said automotive radar, that is extremely important to self-driving cars and autonomous vehicles in itself. And they are a huge, huge influence on that particular industry. So let's take a look and see actually what's happened over the past year with NXP Semiconductors. A year ago, they started at 106.74. They ended today at 119.83. Now, they're not like some of the tech companies that have gone bonkers over the past year. They are up 12.26%, but this is an integral company. This is a company that's a solid performer. They also, hey, for you all, and I have heard from you before that there are some of you out there that love dividends. This is a dividend company. They pay a 1.26% dividend. And for a tech company, there's not a lot of tech companies out there that actually do pay dividends. But let's take a look at the earnings, because the earnings is the second component that we want to look at. If we make the screen just a little bit bigger, you can follow along all the way from 2014. They've had some ups and downs from that standpoint, but I would say on average, they've had more ups than downs, and they're actually projecting into the end of this quarter as to being an increase in earnings as well. If we look at how they compete with other companies that do something similar to them, you would compare them to ON Semiconductors, ST Microelectronics, which is another Dutch company, and Littelfuse, which is actually what you might consider a small cap semiconductor. They've actually done pretty good from that standpoint. The blue, they haven't done as well as ST Microelectronics, but they've kept up with the other companies that are in the same business that they are. Remember, though, that the past performance is not a guarantee of the future results, but also remember now when we get to the moat portion, remember what a moat is? Remember what a moat is. Remember that imaginary barrier that the company digs in between them and their competition. Most of the moat that comes from NXP Semiconductors is from their automotive. They make it the most moat-worthy, let's say. One of the biggest things about the automotive semiconductor business is that the switching cost is huge because there's such stringent quality which is necessary in making semiconductors for cars, especially autonomous cars. You probably have seen in the news where in the development of some of the in the development of the self-driving cars that there's actually been a few accidents here and there. And they are very, very stringent in the quality of the semiconductors that goes into these vehicles, because it can affect the safety of those particular cars, the safety and the reliability of those particular cars. Now, when we look at what Morningstar says, yes, we finished at 119.83. The fair market value is actually not that far off from that. It's $130. So they're actually trading below what Morningstar is saying is their fair market value. They rate them as a 3-star company. Now, when we get into looking at the stars of the different companies, 3 stars I'm going to call GARP. GARP is G-A-R-P, if I can get that out. Growth at a reasonable price. And what that means is that it's not a value stock, it's not a growth stock. It's one that has reasonable growth potential based on its earnings from that standpoint. Now, let's see what the other analysts out there have said about this particular stock. Out of 19 that were polled, 12 of them said that it was a strong buy, 2 said that it was a moderate buy, and 5 said it was a hold. So the average came out to be... So the average came out to be that it's a strong buy, and that's a good thing from that standpoint. Remember, I'm not telling you to go out and buy or sell this. It's just general information and education. Remember, if you need some help with your retirement account, with your investment account, you can go over to my website and sign up for a time to talk to me. It's free. I've got a lot of experience and certifications behind me, and I can help you out. My website is richardsfinancialplanning.com, and if you go down to the bottom of the page, you can see at the dancing cursor down here that you can click on schedule a call to learn more, and then get an opportunity that you and I can get a chance to talk. Okay, so as we finish out this week, I want to remind you of the 3 things that we look for in stocks. The 3 things that we look for, the first thing is going to be the company's earnings. The second thing that we're going to look for is we're going to look at the competitiveness of the company. And then the third thing that we're going to look at is we're going to look at the stability of the company. That's when we talk about the moat of a company. So as we finish out this week, we hit on another 10 great stocks this week. Next week, we'll do it again. We'll get a chance to recharge this weekend. I hope everyone stays well and healthy. So stay tuned for a small disclosure, and thanks a lot. If you like this information, go over and hit the subscribe button, hit the like button. If you're on Facebook, hit the subscribe button. If you are on YouTube. With all that said, have a great week. Thanks for coming.